Chapter. We're talking real money.
You, ladies and gentlemen, our audience are about to experience a unique set of circumstances that rarely happen, but only when the planets align perfectly. And that is Tom and Don, your hosts, coming together in the same room at the same time, despite the fact that it kind of sounds like maybe we are because of modern technology. Today, we are actually in the same room, albeit very, very resonant, very reverberant, because, well, we're at Lake Chelan in Washington. And by the way, why do builders build houses with reverb? I mean, what is with these high ceilings so that all the sound bounces every which way?
It's purty, man. It's real purty.
It's purty, but for sound, it's terrible.
Yeah, it's not very good.
It's terrible. And of course, if there's something to bitch about, Don will find it.
weren't you gonna go off on Lake Chelan earlier? We have Why I Hate Chelan by Don.
I don't. Okay, it's just me. I know some people. I see them out there on the lake in their boats, and I get that going vroom, vroom, vroom up and down the lake in your boat.
I've been doing it all week.
Is a fun thing.
Yeah, I love it.
I don't get that. So that's one.
You don't like being hot. You don't like being cold.
Oh, wait. Yeah, here, because people live here. They do. They live at Lake Chelan.
Yes,
it's not just
do.
a vacation spot.
That's true. Yep.
And I was thinking about that. I'm going, okay, let's see. It's the northern end of Lake Chelan is exactly 50 miles from Canada.
Is that what it is?
Yeah, 50 miles from Canada. What is it in Canada in the winter?
Cold.
Yeah. So what would you think it would be at Lake Chelan in the winter?
Snow.
Cold.
Yeah.
Very cold. I asked some locals. They said, oh, yeah, below zero. And then every time I've come here in the summer to visit with my friends, and coworker, it's ridiculously hot
It
here.
is warm, but you see that big body of water out there? You jump in that. It's a great contrast.
But then the water's cold.
I love that feeling myself. So, yeah, okay, but you said you were going to do this, and now you've done it. Congratulations.
All right, I'm done. You asked me to do it. You actually told me to do it. You set me up.
That's funny.
Welcome to Talking Real Money, where we actually talk about money, but going on vacation is a money thing.
Indeed it is.
Because we know Tom spent plenty on his.
Yeah.
But what we want to talk about today is, volatility. Stock markets are volatile. Bitcoin is more volatile. But lately, stock markets have been a bit bouncy and concerning, but the net result has been pretty tame.
Not much at the end of the week. If you look at this wacky, weird week, can I say weird?
Yeah.
That we just had.
Yeah, you're a Republican. You can actually say weird.
Please don't do that. So, I mean, you had this very Japan losing 12% of its value on Monday, right? The Nikkei. Then here's the part that disturbs me. From the numbers that I've read, there were 8 times more trades in 401ks on Monday than you traditionally see. In other words, people woke up, market was down, they did something with their money. They moved it from here to there. Somehow.
They went to their online portal and moved it from stocks to fixed income.
And they did it on Monday. So, of course, then on Tuesday, they missed one of the biggest days, Don, since 2022. I love that. So they missed the upside of all that. And as you said, at the end of the week, the S&P 500 lost less than 0.5%. So it really was not a big issue.
So pretty much it didn't do anything.
Not really. I mean, it was dramatic. It got headlines, got everybody worked up. But at the end of the day, you were left with cheesecake.
And it's funny, that lack of volatility is interesting given the fact that most people consider stocks to be extraordinarily volatile, whereas I look at our friendly Bitcoin and see that over the last 5 days, it has fluctuated from as low as $54,500
a Bitcoin,
yeah, to as high as $62,000 a Bitcoin. That strikes me as volatility that doesn't just eclipse the volatility of the stock market. There's not even in the same
and here's part
arena.
2 of the same arena. Here's part 2 of that is that Bitcoin is sold as an alternative somehow that is going to give you some sort of protection when stocks roil, right? I mean, so you in this other thing that's going to be okay while stocks crumble. not proven to be the case at all this week. That's troubling, I think, if you really are a Bitcoin supporter.
Yeah, and in the last month, get this, Bitcoin has fluctuated from 57,000 to over 68,000, and then again to as low as 54,000, and then back up to that 62,000 level. How can you stand that kind of volatility, particularly when who knows if it'll last?
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Tom and Don together at Lake Chelan in Washington doing the show, Talking Real Money. 855-935-TALK is our phone number. That's 855-935-8255. And you can actually call us. We're taking calls. We'd love to hear from you. And it's really easy, and it can be about anything, not just what we're talking about. Because today we're talking about the fact that various markets bounce around. They go up, they go down. It's curious where you mentioned that all this money when the market took a dive last week, Friday, and the money earlier this week moved from stocks into bonds in these personal plans. But wasn't it just a few months ago that everybody who called us said bonds are a stupid thing to own?
Yeah, because they've done so poorly, right, for the last 5 years, right? Who would? And by the way, an interim term bond fund, intermediate rather, is now up about 3% year to date. But let's talk about if you really were freaked out, if you really were troubled on Monday, what should you do? Because there are a few things I think you should pay attention to rather than just thinking it'll go away. And number one always is, and I think Jason Zweig did a nice job talking about that this week, is just figuring out a way to ignore it. I know there's a lot of, it's all over the place. It's on my news feed everywhere. It's on the radio. It's on television. But you just got to figure out how you can put it in its place. I'm just not going to pay attention to that. It's news. It's meant to excite. There's another word for that, but I'll let it go. So you just got to figure out how to put that aside. Number two, I think for me, Don, is something you mentioned at the top of the program. And that is you need to know yourself around risk. How much tolerance do you have for the ups and downs? That's the part that most people don't pay enough attention to.
I don't think most people have any clue, really. I think because it's so much of a feeling issue, it's hard to quantify.
It is. It's hard to know
Which
yourself.
Which is why
well.
we have the risk quiz at TalkingRealMoney.com.
Fascinating to me,
and
the number of people
free.
I know, the number of people that ask us for one-on-one help that have already taken the risk quiz. Like, I got an 83. Am I doing? We'll talk about your overall plan first, and that is something that we talk about regularly. You had a call yesterday, guy saying, I've got my plan and I'm working around it, so et cetera, et cetera. But here's number three that I think is more important today maybe than it's ever been in the last 25 years, and that is avoid concentrated positions. Because right now, most people are invested primarily in the Standard & Poor's 500, and even beyond that, they're in the 7 mega cap, whatever you want to call them. And those are going to probably, in my mind, going to be as volatile as anything in the years ahead because they've gone straight up and have a tendency, when things do that, they don't just keep going straight up. They have a tendency to go the other way. And they've gone up. I mean, the S&P 500, even after this rough and tumble week of ours, it's still up 11.5% year to date. So I think those are big. But here's the other one that I think we're all in denial about this, is getting help. So I can deal with this. I got it. The number of people I talk to that tell me that, and I say, Maybe. And maybe you should have a fee-only 100% fiduciary advisor. Maybe you should have a review. Maybe you should know what you're trying to do rather than just going to do it each and every day, because it can be difficult. There's no question.
Well, it can be. It can also be, if you do it right and you can it's the hardest part is the psychological. It can be done. We can change the way we think and act. We've done it. We do it throughout our lives. And to me, that's the big sticking point, is if you can control the emotions, particularly when you're accumulating. You don't necessarily. You need a plan, maybe.
Yeah. Not as much as you're moving into retirement.
I don't know that you need as much ongoing guidance, but a plan certainly helps, because then it's not just a simple matter of trying to pick the right place. And that's one of the issues we all seem to suffer from, one of the problems. And I think it's because of the industry. We all seem to think that there is a right place to be with your money, a wrong place to be with your money. I just need to know how to pick the right things at the right time. And we think that's wrong.
Well, that's what's been sold, right? That there's somebody that knows enough to tell you, here's what to do for tomorrow. I guess that does get back to tuning it out, because every time one of these events happens, whether they're short, long-term, whatever it is, the pundits are going to say, here's what you should do as a result of that. And that is awful advice, because they know nothing more about what's going to happen in the market the next day. They certainly are not going to be giving you good advice. They're giving you self-interested advice that's designed to get you excited to do something generally that's going to help them, right? That's going to pay their mortgage. So you really want to avoid that. And speaking of mortgages, here's another one I think of oftentimes when the market goes this. Do you go to Zillow every day to look at the value of your house?
No, should I?
I don't, because you do that with the stock market, basically, right? The S&P 500 lost whatever percent. Was it 2.3% on Monday? What if your house went down 2.3 and 1% in one day? Would you sell your house? Would you move somewhere else? Would you take action? I love that comparison. Personally.
Yeah, but you really did hit it right on the head when you said that the reason we spend so much time talking about and thinking about and worrying about and following our financial assets is because of the industry's vested interest. They have so much money. There's so much money at stake that, well, think about it for a minute. Have human beings ever killed other human beings for money?
Let's see. Starting now, yes, I'll back up.
Yeah. We'll often
5,000 years?
Anything for money.
Sure.
And nowhere was this more succinctly stated than in an article in the Wall Street Journal. We've been talking about how the insurance industry is fighting tooth and nail to avoid being regulated by the Labor Department.
And winning, by the way.
And they're winning.
Yep.
But why are they fighting so hard?
It's a great quote.
To have to tell people the truth. Why is that? Why do they not want to tell you everything? You'd think, well, if they're honest, then why would they be so concerned about being forced to tell the truth? This guy, a Texas insurance agent by the name of James Holloway.
In a moment of complete transparency.
When he was asked about the reason why the industry is fighting the fiduciary rule, he said, well, the net effect of this will be that my income will decline. Well, gee whiz, then... Gee, James, then of course we need to protect you and the hell with your clients, James.
And this, by the way, is the rule.
If I was one of James's clients, I'd be going, wait, James.
Why is that?
Are you telling me that you're screwing over your fellow Texans?
Boy, you got to be careful with that. And by the way, this is the rule that the Department of Labor has tried to push for the last, I think it's 15 years, that would require anyone giving you advice on assets coming out of a 401k, 403b, et cetera, into an IRA to act in your best interest at all times. And as you said, the insurance industry fights this. They say it's wrong. They think your people aren't going to get the help they need. It's all a bunch of you-know-what. And they're winning again. They got it thrown out, I think, an appeal. Or
in a Texas court.
Yeah, Texas court said not going to happen.
Another agent in Texas said, quote, well, we don't want this because that's not the quote yet. Here's the quote. He didn't want this because, quote, we might be sued just because the client believes they were sold a product that is less financially advantageous to them than another. Well, doggone, boys.
Doggies are going to run on that one, I'll tell you that much.
I hate the insurance industry.
And there's a lot to dislike there.
Do.
Let's just be honest.
I hate anyone who is so self-centered and self-focused that all they care about is their well-being and not that of their clients. It really should be the other way around, but the pity is, in this industry, it is absolutely not.
And they're, as you say, they're just putting it out there. Here's the reality. We don't want to make less money, so we're gonna try to put the cob on.
And we're gonna spend millions fighting it.
Might want to give the number, because if we don't get a call, I'm going to bring my grandsons in from the pool and make them be on the show.
You'll never get them out of the pool.
That's true. They've only been there since about 9:30
get
today.
them out of the pool. But the number is 855-935-8255. 855-935 spells talk, so you can remember it. Give us a call. Let's talk about your money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Your call, always welcome. You're at the Talking Real Money Vacation House on Lake Chelan in central Washington.
Okay, you got that part right. There's no one here with a Texan accent, though, that I've found.
Yes, there are. I'm sure there are Texans. I'm sure there are Texans.
Yeah.
There are tourists from pretty much everywhere riding down the lake in the what I refer to as the equivalent of a waterborne leaf blower.
Yeah, I think that was a very good analogy, frankly. Yeah, you're talking about the jet skis. Yeah.
The jet skis.
They're noisy. They're intrusive. I agree. So.
Yeah. Apparently, they're fun, though.
Yeah, I've been on one. The kids have been on. Yeah, so, okay. I'll plead guilty to that. Yeah, it's a lot of fun. You're going fast. You're going on the water.
Never done it.
Okay.
Debbie and I sat around today. We were talking about we're just not really water people.
And we are. Everybody here loves this trip, so it's good.
I know. And I enjoy the company.
We love having you.
And the food.
Yeah.
The food's always been good.
The food has been ridiculous this week.
855-935-TALK is our phone number, 855-935-8255. Give us a call. We were talking about bonds a little earlier as people were moving their money from riskier assets to less risky assets. Isn't that curious when not long ago we heard from tons of people saying, no, bonds are bad for you. Well, they were bad in 2022?
Real bad. Yeah, lost a lot of money.
2022 was really the worst year for bonds in
maybe almost ever.
Maybe ever.
It was it's been a long time. The mid-90s, I think, 92, 93, somewhere in there.
And in 2023, the year when everybody said, I'm never going into bonds again, bonds, well,
they made some money.
They returned over 5.5% total return.
And again, this year we're looking at 3-4%. But this is a question that comes up a lot. I think you talked about it on the recorded podcast yesterday on the Q&A, which I love. Yeah. So can I tell that story?
You can tell any story you want.
No, you love the story because we were at dinner the other night and I asked the first night you were here, I said, I brought one of my grandsons in. I said, do you know who this is? 'Cause I said, and I didn't say who you were.
Yeah.
And he's never met you, I don't think. And he looked.
Yeah, he had when he was little.
Okay, because he heard the voice. He said, Don McDonald. Because I make my grandsons, when I pick them up on Friday, listen to the podcast. So they love it. Okay. So they knew you right off.
I got to tell you, just another aside. The Airstream has a little leak that I got to get fixed.
Yeah.
And so I contacted the local Seattle area Airstream dealer in lovely Milton, Washington.
Seattle area.
And I was talking to the guy, and I said, can I come into Seattle to do my radio show for a few weeks? And he goes, oh, what's your radio show? I said, well, it's on the station that used to be Como, Northwest News Radio. He goes, Northwest News Radio? He said, what's the name of the show? I said, Talking Real Money. He goes, oh, my, I am honored to be speaking to you. I'm going, honored? No, don't be honored.
But fix the thing, if you don't mind. Yeah, that'll be good.
No, they were very nice. They were very nice. So we're going in Tuesday to get the Airstream fixed. And then...
Uh-oh. Yes? Oh, what? You put your head down, you started scratching your forehead.
Well, the first time I went out in the Airstream when I was just 63, it was a totally different experience.
I don't even remember where you took it that time.
Well, we took it until Virginia, and then it broke down.
That's right.
And then we spent $35,000 fixing it.
There goes Africa, I guess. It takes care of that.
Oh, Africa. Oh, come on. You want to be honest? Africa was more than $35,000.
I can't remember.
I'm guessing.
I can't remember.
I'm guessing. Anyway, Debbie and I have agonized over this, and we have decided that while we are in the Seattle area, that Stella the Excella, or as Tom calls it, the Silver Bullet,
Yes.
or the Talking Real Money road trip vehicle, is going up for sale.
Wait, we're going to list your home on the road with my home in Woodinville at the same
Yes, the
time?
same time.
Are we going to match them up?
Yeah. I think
One goes with the other?
I think your home's going to go for more.
I don't Who knows?
I think your home's going to go for more.
Okay, so you're going to sell the Silver Bullet?
I'm going to sell the Silver Bullet.
Wow, okay.
Because I need to get it's hard work for
Yeah.
But it's fun. I mean, I've totally enjoyed it. We have met some of the best people.
You've met a lot of people along the way.
Seen some beautiful country, seen some not so beautiful country, but seen some beautiful country. Really had a very, very nice 40. We're going to be at 50 days when we're done here.
And so real quick, so how are people going to find out about the big moving sale at Talking Real Money? Where's it going to be listed?
I guess I'm going to put it up on the trip page. Yes, that's where I'm going to put it.
All right.
I'm going to put it up on the trip page. What we're going to do is
This is no joke. You're really doing this.
I'm really going to do it.
Okay.
We're thinking about after the leak gets fixed, we're going to take it to the
I think it's an as-is sale, but that's
the
just
Appella.
me.
We're going to take it to the Appella office parking lot on a
And
Saturday.
then just tell them you got to pick it up or not.
Yeah, while we do the show. No, come by and look
I
at
see.
it.
Okay.
So they come by and look at it.
That would be next Saturday.
Not next Saturday. It's probably the Saturday after.
Okay, the
20 something. Yeah.
24th. Yeah, okay. All right.
So
there you go.
Yeah, so if you guys are looking for a really cool vintage Airstream.
You're going to leave the logo on it?
Yeah, you can have the logo.
Nice.
Promote TalkingRealMoney.com.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Here we are hanging out in smoky Lake Chelan, Washington. It is smoky because there's a fire up the lake.
Yeah, there's a fire like 30 miles up at Stehekin that is very close to taking the town down. 80 people hanging on there, so we wish them well.
My biggest worry is that it flushes the sea monster down this way.
You've been talking about that sea monster for a decade, I
there
think,
have
or longer.
been, seriously, it's a legend.
You kept my daughter out of the lake for like 2 years.
I looked it up. 200 years. The local natives have talked about the Chelan sea monster. They call it the Chelan dragon.
Okay. Yeah. Maybe it's a big sturgeon or something. Huh? Do you think about that?
Of course, it's a big sturgeon.
I'm just guessing. I don't know. I could be wrong.
There's not a real sea monster. I'm just having fun.
Aria
with it.
still thinks there is because you had convinced her of that. So.
Well, she was young and impressionable.
Still is.
I don't know that she buys it anymore. 855-935-TALK is our telephone number to talk about things, money being the biggest one. And Keith, it's your turn. Thanks for calling.
Hey, hi guys. First, thanks for taking my call. I appreciate the advice I'm going to get. That's going to be so sage and help me out today. So thanks in advance. So,
wow.
Doesn't listen very clearly.
Pressure. Yeah,
okay, good.
No pressure. Tom,
no pressure there. Hey,
be nice
question.
this time.
So, I will. Retired university professor here from last December. I also have a side business of writing textbooks and still making some money. So I'm retired from my main job, but I still have about $80,000 a year coming in from textbook royalties. So what I'm calling about is I have about my portfolio altogether is about $4 million, and it's broken down roughly as follows. It's about $1 million in IRA accounts, about $750,000 in a 401k, only $100,000 in a Roth. If I could go back and do anything differently, that would be it, but it's too late. And I have 2 rental properties worth about $1 million. My question is, there's $1 million in cash, and I'm at the age where I'm not so comfortable with the volatility of the stock market, not doing anything rash, but I'm looking for somewhere that I could put a chunk of that $1 million aside for a bunch of years that would be relatively safe. And I'm not a whiz on this next part, but I'm thinking with CD rates for 3 years, 4 years, or 5 years, roughly I'm seeing ones that are not callable are about 3.7%, rough average there. And Fidelity is pitching something, a deferred annuity, and that's one of those magic words that excites a lot of people. But this deferred annuity, I know it may have big fees that this person may make, but the bottom line is I don't care about the fees that this person gets as long as I'm going to be getting what I'm being promised. And it appears that the 3, 4, and 5-year rates are roughly 4.6%, 4.65, 4.6, 4.55. So between those two options, or if you have a better option, and I don't want to get any more stocks, I'm everything else is almost, except for the cash, is and the rental property is in stocks right now. So I'm massively in stocks, and I'm looking to balance out the portfolio with something that's a little safer. So fixed annuity with Fidelity.
So, I mean, my first question to you is, how about a used Airstream? Because I know you can get it for less than the million.
I knew he would do something weird. I knew he would. I knew it.
Call me off the air. We'll set you up, Keith.
Where is the million right now? Just because
it's in cash. It's just in cash.
I mean, but where in cash?
It's in Fidelity, and it's earning. It's in 3 accounts. So just because that's different accounts over time. I've been with Fidelity since the late 80s, but one account's getting about 500,000 is getting 5.16 right now, and the other 2 are getting 4.7 or 4.6.
Okay, but that's all taxable. I mean, the interest.
Yeah. That's okay.
No, no. If I was going to keep $1 million in a cash, like, I would probably use a municipal bond fund, because at least there, and I don't know anything about your tax rate, you're not going to pay tax on the interest. So that'd be one thing to consider. Part 2 is, so you were a professor, and thank you for that hard work. So you're going to get a pension from there. Did I hear that? And Social Security, correct?
No pension, because in the state of Florida, you have 2 options. You have to choose a pension plan or your own plan. I chose the own plan, where I control the money myself once I was vested.
Fair
so
enough.
That's all I've got. And I will get Social Security about $3,000 a month if I go to 66 years and 7 months.
Okay. All right. So you're trying to really figure out how to use this $1 million to supply some source of income without volatility, really, at the end of the day, because you don't want the risk, if you will, of stocks and for that matter, bonds. Is that what I'm hearing?
Yes, exactly. Just some sense of stability. That's it.
Well, first, the reason why annuity contracts yield a little bit more than their comparable 100% government-backed securities, be they CDs or treasuries, is because no matter what the insurance people say, there's risk.
Yeah.
They claim there's a guarantee, but who backs the guarantee?
Right.
It's not backed by the full faith and credit of the U.S. government. It's backed by the full faith and credit of a corporation. Have corporations failed? Absolutely. The reality is, if you go through Fidelity or Schwab, you can do the disciplined approach, which is building a ladder of CDs, where you get higher rates in the shorter end and lower rates at the longer end.
Tom and Don are talking real money.
Do you suffer from Hodgepodge-itis? I'm Don McDonald, and Hodgepodge-itis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or 2. Most who suffer from Hodgepodge-itis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from Hodgepodge-itis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodge-itis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
One of the greatest dilemmas that investors face is the fear of any volatility. It is a common issue. A lot of people are worried about what any fluctuation in principal.
And I think that goes up as you get older because it becomes more important. People tell me all the time, this is all the money I have. Don't lose it, right? I mean, so you could see how that feeling is important if you're retired or close to retired, as Keith is.
Now, I would like to make a cogent argument against that kind of thinking, but the reality is it's
can't beat it.
Exactly. It's built into our emotional makeup. So we're talking to, I don't know if Keith is still there. Are you still there, Keith? I don't think so.
I don't think so either.
Well, we were talking to Keith, and he had a bunch of money that he wanted to keep absolutely.
Not $1 million.
$1 million. That's a bunch of money.
That's a lot of money.
That's a bunch of money.
Yeah.
And normally we would say, well, in fact, in this case, we should still say, don't just focus on one part of your portfolio. We've got all these other pieces, and they all need to fit together. And what we're doing is this fractured investing strategy, which is no longer a strategy.
Because he has some in a Roth, he has some in an IRA, some in a 401k.
And that's, he said, our sage wisdom. Well, our most sage wisdom would be, you need a plan for the whole bloody portfolio.
You need to know how much you need to make on this money before you can make a decision. That's absolutely spot on, Don. But the real question was about the mill. I mean, it's okay. This gets into an argument of looking down the road and telling you, for example, what's going to be best the next 5 years, which we do not know in terms of cash-like investments. I just looked because I was curious at a high-yield savings account. You can still go to Lending Club and get 5%. Which is pretty doggone good for cash.
Yeah, but then you've got risks of the rate falling immediately.
Risk. That's right.
Immediately.
Yep, that could happen. So, and you found if you did a 5-year laddered CD, you could get somewhere around 4%, correct?
Actually, I just did it at Fidelity. I just looked at the current rates at Fidelity for new issue brokered CDs.
Yep.
New issued brokered CDs. If you built a 5-year ladder, now the beauty of a ladder is if you keep the discipline and you never sell them,
you're going to get the money.
You're going to get the return for certain.
Yep.
Okay? It's guaranteed by the U.S.
Not like the
government.
Savings, not like bonds or any of the rest of this. That's right.
Savings are FDIC insured in most cases.
But reinvestment risk there because
the
in 4
reinvestment
years
risk, right?
Go down tomorrow.
So I just calculated the rate, current rate from Fidelity on a 1 year, a 2 year, 3 year, 4 year, and a 5 year CD. Take $1 million, put $200,000 in each of those maturities. Okay?
Yep.
The average return over that portfolio will be 3.95%, absolutely, positively guaranteed safe. Now, the other thing you could do...
But he's going to pay income. He's going to pay interest income on that.
Well, yeah,
tax.
but the reality is that muni bond funds right now, short-term, and again, he's going to have volatility.
Yep. No, you're right. This is a guaranteed way to get that return, hell or high water. Literally, it is. You can't get that from the savings. You can't get that from the munis.
And you can't get that from an annuity. That's what I hate about annuities, is that they are able to legally say they're guaranteed when, in fact, the guarantee is not absolute. We have seen insurance companies default on their annuities.
And if you think back to 2008, we almost saw the biggest of take the tumble unless you and I chipped in, as we did, right?
Which we all did.
Yeah, exactly.
So this is why, and again, I don't like giving this advice very much because it's not serving the purpose of what we believe advice should be, and that it should be holistic.
It's not as interesting. I think it feels self-serving in a way. Like we write plans, calls for a plan.
Right,
you don't have to do that.
What we want,
you got to do one. Yep.
We want you to look at all the bits and pieces and how they fit together, and then determine how to invest. Because the reality is you could build a portfolio of bonds.
Those bonds, yes.
And get potentially a better total return, accepting a little bit of risk. And let me tell you, the little bit of risk, we talked about this earlier. The Vanguard Total Bond Index Fund, the worst year it has ever had, was a total loss of 13%.
That was 2022.
2022.
Yeah, bad.
That was it.
Yep. So, and bonds also are, here's the reason I still like bonds for most people. They are a diversifier. They are a very different type of security than stocks, right? Bonds have an interest rate attached to them. They're going to pay you back your principal in a period of time. Stocks have no such guarantee. Number two, bonds offer you the opportunity to rebalance your portfolio. Look at the spring of 2020 when stocks went down about 30% in a very short period of time. Bonds actually went up. It allowed you to sell those bonds, buy stocks that were down, and then they went back up. Not calling anybody a genius for doing that, but having that disciplined approach. So, and back to part 3 where we began the show. Most people that we know, most of you, need some sort of fixed income just for the buoyancy, as Don mentioned, just to keep you there when things look really ugly. And and that's the other thing I hate about the headlines. The market is down 2.5%. Well, most people aren't 100% committed to the stock market anyway, and most people hopefully are not committed all of that money to the S&P 500. But bonds can give you some help there on the ride down. So I think for most people, they are important.
And just to give you some numbers, the Vanguard tax-exempt bond index fund, which is
the aforementioned municipal bond fund.
Bond fund. It is very well diversified, but it has some longer maturity bonds along with shorter maturity bonds. So you've got some high quality and some lower quality. You've got a mix of bonds. The worst year it's ever had, guess which year that was?
2022.
Good guess.
Yeah, thank you.
Was a loss of 8%.
Okay.
So you wouldn't have had any income, and you would have lost a total of 8%. But in 2023, it had a total return of 6%, which means you had a capital gain over and above the yield. The yield on that fund
probably
right
3,
about now
maybe?
is just a little over. Well, the SEC yield is actually 3.5 currently because rates have gone up a little bit.
Free.
Federal tax-free.
Okay, you're right. In some states.
And Keith was in Florida, so he has no state income
Nobody pays
tax.
any taxes in Florida, so you're good.
Oh yeah, nobody pays any taxes in Florida. Look at my
property.
Look at my property tax bill.
Exactly.
They get you one way or another. They always get you one way or another. So there are options, and but I think the point I'm trying to get to is absolute safety, absolute unadulterated safety. If you're really looking for that, then you have to accept that your returns are going to be not much better than the rate of inflation, because for no risk, this is what I don't think we get. We tend to be a little greedy, a little.
So that's a T-bill then, right?
Yeah, absolute safety. You shouldn't be rewarded for investing with absolute safety. You're not putting your neck out there.
Exactly.
Returns on money are for the use of that money or taking risk. And when you let someone use the money, there always has to be a modicum of risk unless there is a government backing. And even then, of course, you could argue there's a modicum of risk.
Sure. Not much so far, so it's been pretty good.
Really, realistically, not any, because if the U.S. defaults on its bonds, then, ladies and gentlemen, go get that bad-tasting Costco food. Oh, there was a review.
The $2,000 special?
There was a review. I think it was in the New York Times or I can't remember. One of the papers I read so many of them. Somebody did a review of Costco's freeze-dried food.
Yeah.
They said
this is the big thing you buy, put in your basement.
Yeah, the end of the world thing.
Yeah,
one person said, I'd rather be eaten by zombies.
So don't buy it. Just stand at your doorstep and get ready to go.
It was so terrible. One called it mushy or something. It's just rather be eaten by zombies. 855-935-TALK. Call us.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
You called me a scoundrel during the break. A scoundrel.
Because you tore off my list for Monday.
I accidentally tore off your list.
You know how panicked I get if I don't have my list.
You need your list. Tom and his list. You know?
I don't have that list. It's like, how do I get home?
And it's so funny because this is my life. I have my list work wife and my list life wife. Debbie lives off. She has her day timer with her all the time, and all the lists. And
I don't have it. I'm done.
It's a paper day timer.
Well, mine. You can see this.
I see it's paper.
Paper. Yeah.
Okay. Anyway,
this is it. But let's
go back to the bond thing.
No, let's finish the piece with Keith, because this is important. And you mentioned something I think that we all have a tendency to overlook, and that is most of us don't know how much risk we're taking in a general sense with our investments. Most people don't until, 2000 comes along, 2008 comes along, spring of 2020. Then you find out that, oh, wait, this doesn't just go straight up. So going back to where Keith is, and again, I know this sounds repetitive in some ways, until you really know what rate of return you need on your money, that is how much you got to make to sustain yourself, which maybe Keith doesn't need that much. He lived as a college professor for a long time, right? Not making huge money, good money, not huge money.
Well, but from the textbooks, it sounds like he's doing
that's true.
pretty
$80K a year from the textbooks. So there's some but you put all that into the plan, and then you run the number, and then you say, look, you only need to make 3% a year. Why in stocks at all? Don't do it, as you said. Just
why bother with the annuity?
Right.
Just
you don't need
build,
to. The ladder. Yeah, or something simpler, or high yield savings for part of it. Maybe you diversify some there. So you do those things instead of being in stocks, because stocks are more volatile. They have been. That's it.
Yeah. So, but it's about It really comes down to being about a plan. Your portfolio has to be looked at in its entirety. I don't know of any better way to say that. We've got to get out of the mindset that we're building all these little pieces and somehow they're all going to work together. We don't know that they're going to work together. It is a hodgepodge.
And
boy,
we see a lot of
hodgepodges.
I know. We saw a couple new ones this week. That were and not just the hodgepodgery, it's the expense. It's fascinating to me. That's the other part that people don't think about much is how much they're spending. We looked at a new portfolio where the expense ratio, the amount that's going out of the fund into their pocket every year, was about 0.70. And in today's world, you can buy exchange traded funds for like 0.1. You get
0.03, 0.02.
Yeah, right. So it's just no reason to be handing out 6 times as much. Imagine if you're paying that much in gas. I mean, if you're paying how much a gallon instead of $5 a gallon, you're paying $30 a gallon. You're kind of spendy.
I'm spending plenty on gas.
I know you are.
Right now.
So we'll see if we can figure something out there.
Every day, pretty much every day, we had to stop and get gas.
Is that right?
Yeah.
Wow, that's crazy.
Well, I wanted to make sure it was full. I don't want to run out of gas.
That would be bad.
Through the trailer.
Anyway, so back to what you said. It all starts really from, we've said it before, the plan.
Yeah.
If you're there, you got it figured out.
And just want to mention to everybody in the Seattle area that soon there will be an Airstream available for purchase if you guys would like to buy us.
Go to talkingrealmoney.com.
Go to talkingrealmoney.com and go to the trip, the more info on the trip thing, and just send me a note if you might be interested. We're going to sell it pretty reasonably. I just looked it up. A new Airstream 28-foot Flying Cloud, brand new.
What is Flying Cloud? What does that mean?
Flying Cloud is the lowest end model.
Okay.
Starts at
how much?
$119,000.
Wow. So you could get
We're
a lot
going
of money.
to be way, way, way below that.
Okay.
80,
but it still has the wheels on it and all that stuff?
889. Yeah, it's got I just put brand new tires on, brand new brakes, brand new axles, brand new floor,
and brand new Talking Real Money logo.
Talking Real Money logo.
Ooh, beautiful.
And had it shined up a little bit, and it looks beautimous. So go to talkingrealmoney.com and click on the more info button. Send me a note. We're going to be showing it soon. And if you want anything else, just check us out. TalkingRealMoney.com.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.